All right, looks like we are live. Over the last week or so, there's been a number of articles coming out, including Bloomberg News releasing an article about how the Chinese Communist Party wants a larger role, more control over the Chinese economy. So Xi and the other Chinese Communist Party elites want even more control over the Chinese economy. Now, the Chinese economy before the pandemic was experiencing a lot of problems. There is a well-documented now power struggle. If you listen to the shows like China in Focus, NTD News, Joshua Phillips, Crossfire, that cover a lot of this, how Xi is in a fight with China's premier, who is Li Keqiang. And Li Keqiang has given speeches, I think starting in March, talking about how China's economy was having a lot of financial problems. So the mainstream narrative, mainstream financial media narrative, Chinese Communist Party narrative, Chinese state-owned media, state-run media narrative, their propaganda narrative is that China's economy is still doing well. It's bouncing back nicely. China has the second largest economy. However, China's premier publicly gave a speech in March talking about how half of the country, 600 million adults, make only $144 a month. That is it. So half the country, 600 million adults, still in dire poverty. Now, there is wealth in China, but it is not anywhere near the levels that the Chinese Communist Party is claiming. There is an enormous amount of poverty in China, and for that embarrassment, she is very angry with China's premier for giving that speech publicly. There's well-documented now public feuds. They're taking turns making fun of each other, insulting each other in public on Chinese state-owned media. So there is a clear power struggle. Now, over the last week, like I said earlier, the Chinese Communist Party has announced from Bloomberg, this was a Bloomberg article on September 16th from Beijing, Bloomberg's Beijing office. Chinese Communist Party is looking to strengthen its leadership and control of the country's growing private sector. If you're familiar with how things work, they already have control of the private sector in a bunch of different either direct or indirect ways. They've assigned a lot of people to board seats. There's ownership of share ownership of a lot of Chinese companies. Chinese state-owned enterprise banks give a lot of dividends to the Chinese Communist Party. So there's a lot of government control already, but they want to get even more control of the private sector and the economy. Growing private sector and its employees by extending the work of the United Front further into the business community. The party called on the United Front to improve the government's leadership role in the nation's private sector, according to guidelines issued by the General Office of the CPC's, Communist Party of China's. That's another way for abbreviating CCP, Chinese Communist Party, Central Committee on Tuesday, September 15th. The Front is an umbrella organization that aims to increase the party's influence and control both domestically and internationally. The move aims to address emerging challenges and risks as the scale of private enterprises increases and private business people have diverse values and interests. While it's unclear what the new policy will mean for China's millions of private firms, it comes as the state government and Chinese Communist Party are pushing for greater control and influence over more of the economy. That increasingly unclear dividing line between public and private sector is one of the factors behind rising tensions with the U.S. and other states, which ostensibly private firms such as Huawei, I wouldn't call Huawei a private firm. It's the Chinese military has a lot of control over it, and they do a lot of spying. So Michael Bloomberg, he dropped a story a number of years ago where he was going to document exactly how many billions have been stolen by Xi and the other Chinese Communist Party elites. Also, the story was going to make Xi's brother look really bad because over $400 million had been stolen for Xi's brother, and he was, I guess, a degenerate gambler, and he owed a lot of debts in Macau casinos, and he had a problem, I guess, with gambling and hookers. He was basically the Chinese version of Hunter Biden. Okay, well, let me skip. Okay, actually, let me just continue the rest of the article, and then I'll play some audio clips. There's a really good interview that is a must-listen that occurred in the last 6 weeks that Danielle DiMartino Booth did with Leland Miller of the China Beige book. It was on the Valuetainment Economics YouTube channel, but Danielle DiMartino Booth also put it on her YouTube channel. It's over 90 minutes long, but I'm just going to play a couple clips of it. I'll just finish the article and then I'll play some clips. And I'll talk about some of the stuff that's said in the clips. While it's unclear what the new policy will mean for China's millions of private firms, it comes as the state and party are pushing for greater control and influence over more of the economy. That increasingly unclear dividing line between public and private sector is one of the factors behind rising tensions with the U.S. and other states. Ostensibly private firms such as Huawei, I wouldn't call Huawei private. Again, I think this is spun because Bloomberg News does have an office in Beijing. They make billions of dollars a year in fees on Bloomberg terminals, and they can't tell the truth about a lot of things going on in China. Private businesses account for 60% of China's economic output and create 80% of urban jobs, but their position has been difficult in recent years with the perception that the government under President Xi Jinping favored the state sector. In addition, they have borne the brunt of the U.S.-China trade war, as many are export-oriented manufacturers. Okay, so let's play this clip now. It's going to be a couple minutes long with Danielle DiMartino Booth and Leland Miller from the China Beige Book.
Can you kind of quantify, if you will, China's global footprint, how big China is, whether you're talking about gross domestic product, the size of their economic output, or as that of an exporting nation, as well as the rise of the Chinese consumer, which I think is one of the least appreciated stories in the past 5 or 10 years.
Right. Well, some of my information on GDP may be a little bit outdated, but essentially you're looking at a GDP number in the teens, in the low teens, or almost to the low teens. The U.S. is close, around 20 trillion, and you've got a Chinese number that's maybe 11 or 12. But it's the reason that I don't pay attention to it that much is that, as you say, there's a lot of different ways to look at China, and one of the worst is to look at the GDP number, because China's always had this enormous fixation on the GDP number because big growth equals big success. But that's not what happens. And what you see is that this has become a part of the Chinese model, whereas, if the Chinese want to hit a certain economic number, then they'll just build. So the old joke was, if you want to hit 8% GDP, you build a bridge, you tear it down, you build the same bridge again, you tear it down, you build the same bridge again, you tear it down, and you keep going until you hit your GDP number. Because GDP measures aggregate growth and not productive growth. And the largest problem with the Chinese economy right now is there's not enough productivity baked into what they're doing. Enormous non-performing loans, enormous waste, enormous inefficiencies, and they're trying to get away from it, but it's very difficult for.
Okay, he says that China's trying to get away from it. He's in China, or he still has business interests in China. I think he's being too kind. If you've paid attention the last month or so, a lot of the policy that Beijing has suggested is they want to double down on even more infrastructure spending. So China does not want to get away from it. The amount of credit inside the Chinese economy has absolutely exploded since 2008 and 2009. It's up 10x. There was about $5 trillion worth of debt in the Chinese economy prior to around the 2008 financial crisis, and the amount of debt and credit in the Chinese economy has exploded. Kyle Bass, hedge fund manager Kyle Bass, says the total amount of credit in the Chinese economy is now, in the banking system, is now over 50 trillion, and it is still growing. So there's a lot of bad debt there, but there are ways for the Chinese government to prevent it from collapsing and to prevent China from collapsing. Look at the trade data that's come out, and China has record amounts of exports, but a lot of those exports are on medical supplies. They're on N95 masks, they're on masks and medical supplies. So they kind of have, it's not a full monopoly, but they have a large percentage of manufacturing for that. And the Chinese currency, the exchange rate of the Chinese yuan against the dollar, it is now down, I think, to a record. Let me just pull it up really quick. It's at 6.789 Chinese yuan to the dollar. So this will give the Chinese government ammunition if they want to let the RMB or the yuan devalue and weaken a lot if Trump does win the re-election and starts putting on more tariffs. Because if you listen to the China news from like China in Focus over the last couple months and Joshua Phillips, he said that internal Chinese Communist Party documents are saying that they expect a lot more sanctions, a lot more tariffs in the coming months, and them to increase if President Trump does win re-election. So a stronger Chinese currency now will potentially give the Chinese Communist Party and the People's Bank of China ammunition later on to let the currency exchange rate weaken, because if the currency exchange rate was already weak going into potentially even more sanctions against Chinese companies or even more tariffs, then it would be even worse. So if the currency then is already stronger, relatively stronger, it's easier then to swallow allowing the currency to get weak, whereas if the currency was already weak, then allowing the currency to get weaker would start to accelerate inflationary expectations, potentially velocity of money in China. And they're already dealing with food shortages, higher food prices on many items. You're starting to see President Trump just gave a speech earlier today talking about how China over the last month or so has had to import record amounts of, I think, corn, soybeans, cattle, I think maybe even also pork and chicken. And China was importing a lot of soybeans from Brazil, but prices, probably because the Brazilian currency has been devalued a lot against the dollar since February and March. But soybean prices in Brazil are up 14% recently. And probably besides the Chinese government buying a lot of those soybeans, a lot of it has to do with currency devaluation. So for those of you saying that currency devaluation doesn't produce higher prices, you're seeing it right now in Brazilian soybeans, how Brazilian soybean prices are up a lot lately. So let me play the rest of this audio clip on the clip 1, and then we'll get to the second portion.
After decades of being trained to focus on growth at all costs. And I think the other way to look at this, of course, is if you look at per capita GDP, let's assume that has meaning right now, China has 1.4 billion plus people. So they're still a developing economy. They're still nowhere near middle income levels of growth, and which would make them in the same ballpark as Japan or Europe or United States. It's still a very poor country, and it's a country that's getting older. So on the one hand, you've got this extraordinary economic powerhouse, tons of people, tons of economic growth. On the other hand, you've got this enormous population that's very poor, it's very male, it's very old. And so there are these obstacles to China jumping to the next step that are not the same things that we saw with the Asian tigers, that we saw with the US in the early days, that we saw with Europe. So China's got their own unique set of problems right now that they're trying to work through.
Also, China has a lot of stagflation, especially on food prices right now. So they can import more food, especially if they're running these supposed trade surpluses. They would have more reserves to potentially bring in more food, but that's going to drive up higher food prices for a lot of other countries and a lot of other people. Now, we may not see higher food prices here in the US. There might be paper price manipulation of commodities futures contracts, but people at the grocery store, at the restaurant, we may see shrinkflation, where the price might not move at all, and the portion size might drop 10%, 20%, 30%, sometimes even more than that. I've seen that on some dishes at restaurants over the last 5 or 6 years, where there's shrinkflation, where the price of a menu item at a restaurant might not move really at all or very little going up in price, but the portion size drops 10, 20, 30, 40%. And of course, the US government CPI, Consumer Price Index, which is supposed to measure inflation, does not accurately measure that. For whether that's intentional or not, we can debate that, but it's not accurately measuring stagflation, or stagflate and tax and lie, as I call it, or shrinkflation either. Okay, so let me move on to the second audio clip I want to play.
So what do you say to people who say that China's built up so much debt that it is an accident waiting to happen? It's an economy that's going to implode under its own weight. There's no such thing as a scenario that can be painted for there not to be a hard landing. I mean, I hear it all the time.
Not only do I not think that a hard landing is inevitable, I don't even think it's likely. And let me explain why. Hard landing, first of all, has taken on many, many different connotations over the years. So back when China was growing at 8% a year, there were people out there who said if China's growth falls to 6% or so, that's a hard landing. So one of the ways that people have gotten away with having wrong predictions for years and years and years has been you just change the goal, you move the goalposts back. So it's a growth number. The way that I look at hard landing is I look at sort of an implosion, an acute crisis in China. And I don't think that is likely. What's happening right now is an enormous problem with bad debt. The debt that is recognized as non-performing by Beijing is a fraction of what's actually non-performing. Non-performing loans, the technical term, there's a multi-tier classification system, and when the bad debt gets too high in one category, they sort of just push it down and lower the non-performing loan numbers, so they're 2%. A lot of people think that they're over 20%. So there's no question, nobody contests the idea that China has way too much bad debt, and that this is causing a severe problem and a severe challenge to China's economic model. The question is, what's going to happen next? And what I think most people miss in this is that China does not have a commercial financial system. A lot of people looked at what happened to the United States in 2008, and Europe slightly after, and saw the economy sort of implode because parties stopped loaning to each other. You had a liquidity crisis. You had all these things happen because these Western banking systems were commercial financial systems. And what you have in China is something different. The state controls all the counterparties. And so what happens when you have a problem in China is you have one side of the state apparatus just swoosh a tidal wave of capital from one side, whether it's from this fund or from this bank, to plug a hole on that side. And then one side swoosh capital to the other side to constantly plug holes. Now what happens there is you fix the short-term problem, but you're constantly pushing bad money after good. And you're constantly creating less return on investment, less productivity. So potential growth rates will never outpace the growth of debt. And that's a very technical way of saying that the more China just takes all its big ball of cash it's kept hoarded and sort of throws at its problems one by one, it can deal with problems in the short term. It can deal with them much better than a Western economy, for instance. But the problem is over time, it's chased all their good money's chasing bad. They've got a system that's slowed down, it's stagnated. And I think that's the future of China. You've got a stagnated economy that's growing at 1% going forward. And that's a real structural problem. And I think one of the reasons you're seeing so much hesitancy on going big right now in China, despite the closing economy, is that Beijing understands, even if Western economists don't understand, that the debt problem is so severe that if they don't reverse some of this, or at least slow it down, then they're going to be in enormous trouble going forward with an economy that's just standing still in just a number of years.
So,
okay, well, in theory, they wanted to get rid of the debt, and they were talking about that over the summer for the last 4 or 5 months. In reality, over the last month, they decided that that's not going to work and that they need to go back to the tried and true method of central planning and infrastructure projects and more spending. So they're going to keep spending money on infrastructure projects. Maybe the Three Gorges Dam does collapse. I saw an interesting theory from one of my listeners that one of the main reasons that they're stockpiling all of these industrial metals and other commodities now is they're anticipating that the Three Gorges Dam will collapse in the next couple months and that they already have the metals on hand stockpiled to prepare for that. And then they have all these other infrastructure projects that they can do to try to do that afterwards. So we'll see. But China's accumulation of commodities, they do these things in cycles. So when something is cheap, they tend to stockpile a lot of it, especially if it's a metal, and they could put it in a warehouse and maybe protect it from getting rusted. Although who knows if they're there's a lot of stories with the Chinese reverse merger frauds of like all those the assets just going bad. But they do stockpile an enormous amount of commodities, and then after the price runs up, they stop buying. And then they wait for the price to crash again, and then they continue the cycle. That's normally how they do things. And there's been new policies out of Beijing that they're going to have to stockpile even more commodities. That was a policy announcement in the last month or so. So they tend to buy in enormous amounts. They run up the price a lot in a commodity, and then it collapses, and then they debate buying it again. They do manipulate a lot of commodities markets, though, in my opinion. So it's not just the paper price manipulation. The Chinese economy, Chinese government is also a Chinese private sector, Chinese state-owned enterprises are also an enormous component of the demand side of many commodities, especially industrial metals. The People's Republic of California is a satellite state for China. They have some real estate and construction corruption in Los Angeles. There's some scandals from Los Angeles area politicians with some development projects. But honestly, I lived in California a long time. I moved out years ago, but I did grow up there in Southern California. I think California resembles more of a European Union country. I think California resembles more of a more wealthy Greece or a more wealthy Italy rather than China. That's just my opinion. I wouldn't worry about Kyle Bass shorting the Hong Kong dollar. I think he's doing fine on his other trades. He disclosed last year that he was short HSBC Bank, and the journalist, and I'm using air quotes on Yahoo Finance, refused to acknowledge that. He was very heavily short HSBC Bank a year ago. So he's racking in the money being short HSBC Bank. In fact, I had an off-the-record conversation with Kyle Bass, and he's not optimistic about the survival of HSBC Bank without a bailout. Let's just put it that way. Okay, let's see here. We're at 20 minutes. I don't want to go any longer than 30 minutes. I'll take a look at some live chat questions or super chats if they're here. There are no super chats. I know it's late, but I wasn't feeling well earlier. It sucks when you have the health problems I do. You don't know when you're going to feel good for 20 or 30 minutes. You do the best you can. But there is a new article about what happened earlier today with Sandstorm Gold and Royal Gold. I honestly think even if it was an unpaid intern that screwed up at Royal Gold, that's a big, big mistake. Potentially tens of millions of dollars worth of damages were done by Royal Gold to Sandstorm Gold. So either Sandstorm Gold there's a potential lawsuit there. I think there's legal liability having been in law school. Or Sandstorm Gold's going to be able to renegotiate and get way better terms on a potential large silver streaming deal. And the details of the deal leaked out earlier today on Monday, September 21st. So if you want to take a look at that, it's only $5 behind the paywall. It's a lot of detail on analysis. Also, my time in law school, there's some extra analysis there about potential legal liability and potential remedies that Sandstorm Gold has. But yes, there's potentially tens of millions of dollars in damages that were done to Sandstorm Gold today by what looks like an accidental news release on the Royal Gold website. Hello, Adon. That's like your 6th copy and paste job. I have tons of research and analysis behind the paywall for my Patreon account contributors. Sorry you don't want to pay $5. Again, there's lots of coverage on the precious metal royalty and streaming companies. There was an article in the last week or two about optionality for silver miners, and I'm sure there will be more articles coming out in the weeks to come about gold and silver miners. The gold miners are still making very good margins at current prices, especially with oil prices stuck around $40 a barrel, and we may have weaker oil prices in the not too distant future. That may also be additional coverage behind the paywall there for patrons. There's tons of oil articles coming out, so there's stuff I could cover for the oil market. Maybe I'll get something done in the next couple days. There's also something I've been wanting to write about the natural gas market. I'm very long-term bullish on natural gas and LNG. I think there's going to be a lot of demand for it. I think coal demand is going to be replaced by natural gas demand, except maybe in China. Okay, well, that's it for this short live stream show. I have a bunch of other articles on the Chinese Communist Party's policy of wanting to take over more control of the economy. The links will be below the video in the information and description section. Also, if you want to watch the 90-plus minute interview that Danielle DiMartino Booth did in the last 6 weeks or so with Leland Miller of the China Beige Book, the video link will be below the video in the below this live stream show in the information and description section. Also, there will be a link at the end of this video as well.